Good morning, hunters, and welcome back to the Daily Hunt for Multibaggers. It's Friday, May 8th, 2026, and we've got a packed show for you, diving into the latest market buzz.
That's right, Ethan. Our AI dug deep into discussions from yesterday, May 7th, and it was a busy day in the market commentary space. We saw a significant number of posts flagging a diverse array of stocks, with a real mix of bullish excitement and, frankly, some pretty serious warnings.
Absolutely. There's a lot of energy out there, some really speculative plays generating buzz, but also some more fundamental growth stories gaining traction. It feels like a moment where the market is trying to figure out if it's risk on or risk off, you know? Let's get right into it.
First up today, let's talk about Coinbase Global Inc., Coin. Our AI-generated insights show minimal current user sentiment, but it did flag a historical positive trade from one user. What's your take here, Ethan?
Well, you know, it's a crypto play, and those can be exciting. We saw a buy rating for Coin back in October 2025, but then it shifted to stay away in February. The data also showed some notable insider buying recently, over 1 million shares purchased. To me, that's a powerful signal, suggesting those closest to the company see long-term value, even with the recent Q1 loss they reported. Plus, discussions around multi-coin ETFs could be a future tailwind for the broader crypto market, right?
Insider buying is always interesting, Ethan, but we have to look at the cold hard numbers. Coin just reported a Q1 loss and lagged revenue estimates. Their revenue growth is actually negative, which is a significant red flag. And let's not forget that beta of 3.38. This stock is incredibly volatile. A price-to-earnings ratio over 43, especially with negative revenue growth, suggests serious overvaluation. Unless we see a clear path to profitability and consistent revenue growth, relying solely on insider sentiment for such a volatile stock is risky.
Fair points, Brooke. It's certainly a high-stakes arena.
Indeed. For Coinbase Coin, our final verdict is to stay away. The current financial performance and high volatility outweigh the speculative long-term positives for now.
All right, moving on to Figma Inc., FIG. This one showed up multiple times in our analysis, and there's a lot of user discussion around it. Some of it, well, quite passionate.
Passionate is one word for it even. The user sentiment is overwhelmingly bearish. We saw comments like cratered stock with dim outlook, and people advising others not to buy into the hype. One user even reported losing over $14,000 on their FIG position. And this isn't new. We've had stay away or speculative gamble ratings for FIG consistently since January. But wait, the company actually reported Q1 earnings and revenues that surpassed analyst estimates. That's a positive operational beat, you know? And they've announced a long-term partnership with actor Noah Weil for brand building. That sounds like a potential turnaround story. Ethan, that earnings beat is a classic head fake. The stock dropped 15% immediately after beating those estimates. That tells you the market has deeper concerns. Their net profit margin, EPS, and operating margin are all deeply negative. Revenue growth is a paltry 0.4%. And let's not ignore the insider selling of over $800,000 worth of shares. A celebrity partnership is great for PR, but it won't fix fundamental unprofitability or a highly leveraged balance sheet.
All right, Brooke, you've definitely highlighted the substantial risks here.
Absolutely. For FIG, the verdict remains a strong stay away. The fundamental financial weaknesses and negative market reaction to even good news are too significant to ignore.
Next up, Cloudflare Inc., NET, another one that our AI flagged. The related posts were mainly about a trader's journey, not specifically about NET, but the company itself has some interesting data points.
Interesting, yes, but again, a mixed bag. Cloudflare's Q1 earnings and revenues beat estimates, but the stock subsequently dropped 12%. Sound familiar? While there was some insider buying, their net profit margin and EPS are both negative. Their price-to-book ratio is an astonishing 61.92, and the PEG ratio is 2.38. That screams extreme overvaluation for a company still operating at a loss. Plus, the debt-to-equity ratio is over 241, indicating very high leverage.
But Brooke, they have really strong revenue growth, over 33% annually. That's what you want to see in a high-growth tech company. The insider buying, that 6.66% net increase in insider holdings, shows that the people running the show have confidence in their future, even if the market reacted poorly to the Q1 report initially. These are companies building the infrastructure of the future.
Growth is great, Ethan, but growth at any cost, coupled with such high valuation metrics and substantial debt, is a recipe for risk. The market drop after an earnings beat suggests investors are looking for profitability, not just top-line growth. Until they can translate that revenue growth into sustainable positive net income, that valuation is just too high for the inherent risk.
I hear you on the valuation, Brooke.
For Cloudflare, net, we have to classify it as a stay away for now. The significant unprofitability combined with extremely high valuation metrics and market skepticism make it too risky despite strong revenue growth.
All right, let's talk about Rocket Lab Corporation, RKLB. This one always generates a lot of discussion. We saw multiple posts about it with some really strong long-term optimism from the community.
Yes, there's definitely long-term optimism, Ethan, but the short-term sentiment around specific trades was overwhelmingly bearish, with warnings about IV crush and expecting gains to reverse quickly. We've rated RKLB as stay away or speculative gamble many times, most recently yesterday. The company is still deeply unprofitable, with a net profit margin of nearly negative 33% and negative EPS. Their debt-to-equity ratio is over 15, and the price-to-book is an eye-watering 24.8. And let's not forget the insider selling of over 3.6 million shares. A celebrity partnership is great for PR, but it won't fix fundamental unprofitability or a highly leveraged balance sheet.
But the news, Brooke. Rocket Lab just reported record quarterly revenue of $200 million, exceeding estimates, and their backlog is over $2.2 billion. They secured their biggest launch deal yet and acquired a robotics leader. These are massive catalysts for a growth company in an emerging sector like space. This isn't just future potential. This is execution that will drive KPIs higher over time.
You're right. The news is indeed very strong for future revenue, and that backlog is impressive. But those metrics haven't translated into profitability yet. A negative net profit margin, high debt, and valuation multiples that price in immense future success leave little room for error. The insider selling also gives me pause. While the long-term potential is exciting, the current financial health and the risk-reward profile as of today demand caution.
It's definitely a wild ride for RKLB investors, that's for sure.
For RKLB, given the current financial state and high risk despite the exciting news, our verdict for today is stay away.
Finally, we've got Datadog Inc., DDW. Now, this is where the market commentary started to turn really bullish. Our AI flagged strong user sentiment, calling it a fighter that was undervalued.
And for good reason, Ethan. Datadog reported Q1 profits that more than doubled and revenues that topped estimates. Multiple analysts raised their price targets, and Wedbush noted accelerating demand across AI and their core products. That's a compelling growth story, especially since our last rating was stay away in January 2026. This looks like a significant upgrade.
Exactly. This is exactly what we look for in a potential multi-bagger. Strong revenue growth at nearly 30%, positive insider buying, and those surging profits. It really seems like DDOG is executing incredibly well and expanding into high-growth areas like AI.
Agreed. The momentum is undeniable, and the profit growth is very encouraging. However, we still have to acknowledge that price-to-earnings ratio of 471.82. That is an extremely high valuation, even for a high-growth company. While profits doubled, their net profit margin is still a relatively modest 3.14%. They need to continue that incredible profit expansion to justify that lofty PE. It's a fantastic company, but a significant portion of its future success is already priced in.
That's a fair point on the valuation. It shows how much the market is betting on their continued trajectory.
Precisely. For Datadog, DDOG, we're going with a cautious buy. The company's exceptional growth and improving profitability are strong signals, but that valuation means careful consideration is a must.
All right, Brooke. That was a busy morning, but some really interesting insights. Let's wrap up with our compiled list for deeper analysis today. Investigate as buy, none. Investigate as cautious buy, Datadog, DDOG. Investigate as speculative gamble, IREN Limited, IREN.
And that brings us to the end of another episode of the Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in, everyone. We appreciate you joining us on this Daily Hunt.
Until next time, happy hunting.